Hi, welcome. Thanks for watching and I appreciate you being here. Today's video is about target date funds. I wanted to talk about target date funds, what they are, and why I'm not a big fan of them. In this video, I'm going to define what a target date fund is. I'm also going to explain the concept of a glide path. I'm going to give you some features of target date funds, and then I'm going to discuss some of the flaws of target date funds and why I hate them. Okay, so maybe hate is a strong term, but I'm going to discuss the flaws that I perceive in target date funds and why I got away from them as soon as I started better understanding what investing is. But just because they're flawed doesn't mean that nobody can benefit from them. So I'm also going to tell you the kind of people who would be better off with a target date fund. But first, here's a little bit about me. Hi, welcome to my channel. Thank you for watching. Here's a little bit about me. My household consists of myself, my husband, and my toddler. My mom also lives with us, but she's not included in our finances. We live in a high cost of living city in the Northeast. My husband and I both went to graduate school, but fortunately, we no longer have student loan debt. I work in banking and he works in aviation. I take care of the family's finances and I love my role as the self-appointed CFO. I love to talk about all things money, whether it's investing, saving, or making money. I look forward to sharing a wealth building journey with you. I look forward to getting to know you, and I hope you enjoyed this video. Target date funds are known by many names. They can be known as life cycle funds, they can be known as age-based funds, or they can be known as a dynamic risk fund. Typically, they are based on 5 to 10 year increments, and your allocation is going to be very specific to the time frame that you're targeting, hence the term target date, with a more aggressive allocation the further you are from your target date, and a more conservative allocation as you get closer to your desired age. That allocation changes based on what they call a glide path. A glide path is a shift of this fund's assets from one asset class to another over time. There are different types of glide paths and they meet different types of purposes. Here are some of the main ones. First, there's a declining glide path. Declining glide paths reduce equities over time and give you more fixed income. That is very common because one of the biggest reasons why people use target date funds is for retirement purposes, and typically you don't want to run out of money in your later years. In order to reduce your risk, you get exposed to less equities in the market and you get a more conservative allocation in retirement. If you are enjoying this video so far, don't forget to hit the like button so the algorithm knows that it's good, and of course subscribe for more content. If you think any of the information that I provide here might be helpful to somebody else, be sure to share it with them. But there's also a static glide path. A static glide path is one that gives you the same allocation once it reaches your target allocation. So it's not based on your age or number of years, it's more based on the kind of allocation that you're targeting for your portfolio. Once you reaches that allocation really doesn't change unless the fund's objectives change. It's not very common, but it keeps you from running out of money because you have more equities, which allows you to accumulate more over time. The whole point of a static glide path is to mitigate longevity risk. Conventional wisdom does tell us that we're supposed to get more conservative over time. However, with conventional wisdom, people were also more likely to retire in their 60s and die in their 70s. But these days, life expectancy is in the 80s and some people are living into their 90s. Not to mention that some people are retiring in their 50s, if not their late 40s. We know that people strive to retire earlier and earlier every year. So longevity risk is now an even bigger risk than traditional retirement planning was accounting for. So a static glide path is one of the tools that managers use to try and mitigate that risk. And finally, there is a rising glide path. In this type of target date fund, you start out with a lot more fixed income, but as bonds mature, equities start to increase. I could not find as much data about a rising glide path, but I do think that results vary. There is some research that indicates that it is the more superior glide path, but I think that people also have to account for the fact that we are in the longest bull run in history, and that fact alone might be skewing the results. Risk always looks good in rising markets. Everybody has an appetite for risk in a rising market, but not necessarily in a prolonged bear market. So while there is some data out there that says a rising glide path might be the better option, I am a little bit skeptical, and I'm willing to take that with a grain of salt until that fact is proven that it can sustain itself in a down market scenario as well. Here are 3 notable features of target date funds. First, it is arguably one of the simplest investment solutions out there because it requires no attention from you. You don't have to rebalance, you don't have to do anything. All of that is done by the fund manager as time progresses. Second, it is very diversified. That means it eliminates the need for other assets. You don't have to go out and chase different kind of asset types because presumably the fund is going to have it all. And third, it is a very popular fund for retirement, but you can really use it for anything that is far enough out into the future. For example, if you're saving for college or you're purchasing property, not in the immediate future, but further down the line. So yes, while it was initially designed to meet your retirement objectives, you are not restricted to holding it in a retirement account. You can hold a target date fund anywhere, and that does allow you to plan for the future. Now that I talked about some of its features, here are some of the reasons why I think they're flawed. Number 1, they have fewer ETF options. Most target date funds, in my experience, have been mutual funds. Mutual funds have their own drawbacks. They certainly serve a purpose, but I'm not a big fan of mutual funds. I personally prefer ETFs. I actually made a video about the difference between mutual funds and ETFs and why I prefer ETFs. So go ahead and make sure you check that out so you can get more detail on why I'm not a big fan of mutual funds. And I will certainly link it in the description box below. One of the features of target date funds is that all of the work is done for you. The set it and forget it characteristic of this type of fund does come at a premium. Even if you wanted to do a target date fund, what is really stopping you to look at the composition of the fund in the prospectus and rebalance your own portfolio according to the same glide path for less money? You can probably do that for far less money than the 50 basis points you're going to pay a fund manager to do it for you. Evidently, we know that there's no such thing as a free lunch, and investing is no different. The ease of a target date fund does come at a cost. And the third, but probably one of the most important flaws that I find in target date funds is that it assumes that all investors in a certain age group has the same risk tolerance and appetite. You might want to retire earlier, or you might want to retire later, in which case, at a minimum, you might have to change your target date. But you might also have other sources of income, like rentals, pension, inheritance, all of which would reduce the need for you to have a lot of fixed income in your portfolio. Some people are a little bit more conservative, some people are a little bit more aggressive. If you have a much lower appetite for risk, a target date fund that is in your age group might be a little bit too aggressive for you. On the other hand, if you have a better safety net or a more reliable source of income outside of your investment portfolio, you might want to be a little bit more aggressive. Personally, I-bonds are my only bonds. I don't really have any other type of fixed income because we do have other sources of income outside of our investment portfolio. And to me, it just seems like it's a little bit too simplistic to assume that every 30, 35, or 45-year-old has the same needs, wants, and expectations. But just because I don't like them doesn't mean they're all bad. There are some people who would benefit from a target date fund. Let me tell you who they are. New investors. Some new investors are not necessarily confident in their abilities. They may not know what to invest in. And while they try to figure things out, it might be better for them to be in a target date fund over gambling with their money or over sitting out the market altogether. I'm not gonna lie, target date funds is how I started investing. That's how I got my foot in the door. I left all of my retirement accounts in target date funds until I could understand better how investing worked. And once I started building more confidence, I moved my investments out of target date funds into ETFs to construct a portfolio that aligned better with my risk profile. I would rather see somebody in a target date fund than not investing at all. So if this is what you need to get started, there is nothing wrong with that. Number 2, busy investors who don't have time or who aren't interested in constantly looking at their portfolio. For some people, the higher expense ratio might be worth the convenience. I love talking about personal finance, making money, saving money, and investing money. I wake up every day and I can't wait to find somebody to talk to about this stuff. When I feel like my husband is sick of listening to me, I get online and I make a video and I get it out of my system, because whether or not somebody watches the video, at least I got to say it out loud and I'm satisfied. This is how much I love this stuff. But not everybody shares the same passion for this kind of thing. For some people, it is nothing more than a chore. And if a target date fund makes their life easier so they can go about their business, I am all for it. Number 3, emotional investors who react to market news. That might be a new investor, that might be a seasoned seasoned investor, but some people are emotional. After all, money is a big deal. It's not the biggest deal, but it certainly is a big deal. We exchange our time for money. We put in a lot of effort and brain power into making our money. And once we earn that money, that's money that we use to provide for our family and secure our futures. There are life and death implications when it comes to money, so it is not a surprise that part of personal finance is behavioral. All of this means that it's very easy for investors to make bad decisions, to take bad bets, to panic and react to market news. These things are less likely to happen to people who hold target date funds, because presumably the target date funds holds all of the market in one way or another. You're not paying attention to individual stocks and selling at a loss every time bad earnings come out. Instead, you put your money regularly into the target date fund and the manager does all the work for you. And if being in a target date funds means that you're not going to hamstring yourself with bad trades, then I support it. And finally, investors with very simple investment plan who have average to moderate risk profiles. If you are an average person for your age group, and I don't mean that in the insulting way, I mean that you are not looking for less risk, you're not looking for more risk, you don't have additional investments, you don't have other sources of income, and you have that one source of income and you're not anticipating more, you are just what they would call the statistical median. It might just be simpler for you to maintain your money in a target date fund. What you're going to do anyway is not going to change the outcome that much. So if your risk profile is moderate and you really are the very average person for your age group, there is nothing wrong with having the simplest investment portfolio to go with the simplest investment plan. That's all I have for target date funds today, but before I leave, I have some questions for you. Do you have any target date funds in any of your investments, whether it is your 401k or your own individual investments? How do you feel about them? Leave me a note in the comment section below and let me know what you think. I will see you in the next one. I would like to continue sharing my thoughts on all things money with you. So I would appreciate it if you could help out the channel by liking this video and sharing it with anyone you think might benefit from it. If you want to see more content, be sure to subscribe and hit that notification bell so you can know when new videos come out. I'll see you in the next one.